Hello, I'm Marianne Deveni. Can you be both a hawk and a dove at the same time? Well, the Federal Reserve did just that this week, walking the line. So why is it so important and people scrutinize it so much? And what does it mean to your portfolio? Well, I'm joined today by James Marple, who is Senior Economist at TD Bank Group. Well, let's start off, James, with defining. Some people may not be quite as remembering what a hawk and a dove is. What do they mean?
Well, a dove is basically someone who'd like to keep interest rates lower, and a hawk is someone who'd like to raise them. Usually a hawk is someone who's more concerned with inflation or the risk of inflation. And I would say recently, since the financial crisis, someone who's concerned with the impact on financial stability of having low rates for a really long period of time. A dove is someone who would be more concerned with potentially the labor market and unemployment, bringing down unemployment, or someone who's just more sanguine about the risks of inflation. But again, the bottom line is a dove generally would be someone who'd keep interest rates lower, and a hawk someone who would raise them.
So it was interesting today this week that the Federal Reserve was able to satisfy both of those sides of the equation.
Yeah, well, it was interesting. This was one of the statements that the Fed does that has two parts to it. It has a statement, and then it also releases projections for both the economy, inflation, unemployment, as well as where members of the Federal Reserve see interest rates in the future. So the statement itself was pretty dovish. It didn't change much of the language. I mean, there's been a lot of economic momentum in the economy, and the statement kind of underplayed that, didn't really recognize it. And there's another element of the statement where they've been talking about leaving interest rates on hold for a considerable time after asset purchases end. We know asset purchases will end in October. The statement said that as well. So leaving that in, there was a lot of expectation that they would remove that because we're getting closer to when we think the first rate hike will be. So leaving that in, I think it made it a pretty dovish statement. But on the other side of things, their projections of members from the Fed were more hawkish. They relative to what the market was expecting, they showed an increase. They actually showed an increase relative to the previous statement in June, or the previous forecast in June, to where members see the target for the Fed funds rate at the end of 2015, at the end of 2016. So that was hawkish. So you had both elements.
And that was really the surprise then, the moving of the dots?
It was, yeah, and again, I mean, there was some, obviously, a lot of uncertainty about that considerable language, the forward guidance, right. But on the dots, I don't think anyone had expected quite the movement especially the 2015, end of 2015 dot, which is now closer to 1.5%. From where we are at zero, that's a bit
pretty significant, yeah. Now, what about the jobs data? That seems to be now the magic number to watch.
Well, it is, and I think, in fact, that was where we expected to see a little more recognition. I mean, the job data in the United States has been very positive over the course of this year. There have been about just under 300,000 more jobs created this year in the first 8 months than the average over the previous 3 years. So it's been a pretty good run of jobs data. Now, the August number was a bit disappointing. It came in well under expectations, but there's a broad number of other labor market indicators. If you look at the number of job openings, they're back to the peak level prior to the recession. We've seen hiring, kind of gross hiring rates, and people feeling more confident enough to quit, that both of those have gone up. That seems to show more confidence in the labor market. You've had even surveys of small businesses pointing to increased hiring. So the labor market strength, I think, is really, in part, probably the reason why the Fed has become a little more willing to raise interest rates, or at least members are thinking interest rates could be risen a bit faster once they do start to come off the floor.
So was there anything said in the meeting that would change your outlook for the U.S.?
Not really. I mean, Janet Yellen's also had a press conference, so that was another bit of information. But she didn't reveal too much. She's very cautious in terms of saying the outlook is very data dependent, and that's all pretty well known. So I wouldn't say there was too much. The biggest surprise were those projections that came up, I think, a little bit more than people had been anticipating.
All right. And why do people scrutinize this so much, I guess? It seems to be such a big deal. Almost every word is looked at as to what could that possibly mean. Yeah. Well, I mean, if we look what happened last year in an episode now called the taper tantrum, and that was just the then Fed Chair Ben Bernanke talking about
we will eventually be unwinding our asset purchase program, slowing our pace of asset purchases. And the reaction in markets was large. It was you saw that long-term interest rates rose in very short order within a couple of months by about 100 basis points. There was an equity market reaction, although less than what you saw in fixed income. But there can be very big movements in interest rates as a result of changes in Fed language. So I think that's actually something that the Fed is very cautious about. They would like to avoid a reaction that threatens the recovery. And of course, what we saw last year was after that market reaction to the Fed taper, they actually they didn't taper asset purchases in September as was expected, and they held off until December. And I would even go so far as to speculating that some of the movement in the dots is to try to guide the market so that they're not surprised once interest rates do start to go up, that starts to get priced in a little bit more gradually. Because what they're worried about, again, is an abrupt movement, something that would disrupt markets, potentially, have an equity market correction involved with it, or something that, it has global implications. We really saw emerging markets hit really hard when that market reaction was so abrupt. So, it's important, not just on interest rate. The other thing I think is that we've been 7 years of zero interest rate policy by 2015. I mean, it's been since 2008. So this is the biggest action we've seen in terms of short-term interest rates, in terms of the Federal Reserve, for quite some time. It's bound to get attention.
Yeah, that's true. And I guess the big takeaway then for investors' portfolio is then to be prepared, that it looks like in the next year, maybe or so, we're going to see rates move in the U.S. Potentially, then I guess that leads us to Canada as well, and to prepare our portfolio for that.
That's right. And in Canada, I think there's a reluctance to raise before the Fed moves, but we had some inflation data out today that was actually pretty strong, a little bit stronger than expected. So again, I would say that we've been saying rates would come up for a long time, but I think that the real momentum, especially in the U.S. labor market, really makes the case that the unemployment rate's at 6.1%. It won't be long until we're back at what is considered a pretty full level of unemployment, and that will mean that rates will go higher.
All right, thank you very much, James.
You're welcome.
I've been joined by James Marple, Senior Economist, TD Bank Group. Thanks for watching.